Welcome to the Deep Dive. We're here to cut through the noise and give you the key insights from the latest earnings calls.
And today, we're looking at Capital One's second quarter 2025 call.
Right, and this one was pretty significant. The first real look we've had since they closed that huge Discover acquisition.
Exactly. It's a really unique, maybe early window into what happens right after a massive strategic move like this.
Right.
We're going to, unpack the numbers, but also dig into the why, the strategy behind it all.
We want you to understand not just what they reported, but why it matters for, well, one of the biggest financial players out there.
Let's get straight into it.
Okay, so let's start with those immediate sort of headline numbers for Q2. High level, as you'd expect, the Discover deal, which closed May 18th, really shaped these results.
Massively.
They reported a GAAP net loss of $4.3 billion. That sounds pretty jarring. It works out to $8.58 per share.
Yeah, the number definitely grabs your attention, and this is crucial, you can't just stop there. That GAAP loss, it's almost entirely down to what's called provisional purchase accounting. It's the complex financial heavy lifting you have to do when merging big companies. Think legal, accounting, rebooking, everything.
So stripping out those one-off non-cash items from the acquisition, plus a small legal reserve addition, what does the picture look like then?
Much healthier.
Oh.
Adjusted net income was actually $2.8 billion, or 5.48 cents per diluted share. So that contrast is, well, it's vital. It shows the core operation is strong, separate from those temporary accounting hits.
And the revenue side, does that tell a similar story, suggesting good underlying performance?
It does. Revenue jumped $2.5 billion. It's 25% compared to Q1. Adjusted revenue, even better, up 26%, or $2.6 billion.
Okay, and pre-provision earnings, the profit before setting aside loan loss reserves.
Big jump there too, up 34% GAAP, and a really strong 40% on an adjusted basis. Again, that's largely Discover coming in for part of the quarter, but also, Capital One's legacy businesses performed very well too.
So these initial numbers, especially that GAAP loss, are really more about the mechanics of integration, not a sign of weakness.
Precisely. It's the accounting reality of bolting on such a huge new piece. It doesn't reflect badly on the day-to-day business. It's just that necessary, kind of dramatic first accounting step in merging these two giants. Sets the stage.
Okay, that makes a lot more sense. Let's dig a bit deeper then. How exactly did the Discover acquisition ripple through the financials? I imagine there were some complex adjustments.
Oh, absolutely. That provisional purchase accounting hit several key areas. For starters, Discover's U.S. card loans and personal loans. They are now in Capital One's credit card segment. The deposits and network stuff, that's in the consumer segment now.
Right, recategorizing things.
And they brought over significant balances. Roughly $98.3 billion in domestic card loans, about $9.9 billion in personal loans, and a huge $106.7 billion in deposits. Now, each of these came with what are called fair value discounts.
Fair value discounts. How does that work exactly? Is it like getting them cheaper?
Sort of, but it's an accounting concept. When Capital One bought Discover, they had to reassess everything. Loans, deposits, at their current market value. That often means applying a discount to a book value. For instance, the domestic card loans had a $220 million fair value discount.
Okay.
It's not a loss. It's just adjusting the acquired assets to their estimated market worth on Capital One's books. And then the amortization, sort of spreading out of these fair value marks, actually decreased net interest income by $85 million this quarter. Is how those discounts get recognized over time.
I see. That's a key point. What else really shifted on the balance sheet or in expenses?
Well, a big one was the allowance for credit losses. It's basically their cushion for potential loan defaults.
Their rainy day fund.
Exactly. The estimated credit losses already embedded in Discover's loan portfolio, the net credit mark, led to an $8.4 billion increase in that allowance on the balance sheet.
Wow, $8.4 billion.
Yeah, and that flows through the income statement as an $8.8 billion provision expense for what they call non-PCD loans, loans not already deemed credit impaired. It's basically Capital One building up its reserves for the new Discover loan book. Very conservative accounting.
Okay, so building reserves. What about those amortizing intangibles you mentioned? Sounds complex.
Yeah, it's a bit of a mouthful. Intangibles are non-physical assets, right? Like brand value, customer lists. Amortizing just means their value gets expensed over time, like depreciation for a building.
Got it.
So the deal created several big ones. A $1 billion core deposit intangible, a massive $10.3 billion for purchased credit card relationships, and $1.5 billion for network and financial partner relationships.
And the impact of those?
The amortization, the expensing of these new intangibles added $255 million to Capital One's non-interest expense in Q2. So you put it all together for the partial quarter. Legacy Discover added $2 billion in revenue, but contributed a $6.4 billion net loss, mostly because of all those accounting adjustments we just walked through.
That really clarifies the immediate accounting effects. Now, what about operational metrics? Efficiency, net interest margin, or NIM. Did Discover move the needle there too?
Yes, definitely. First, some reporting changes from the merger actually improved their reported efficiency ratios in Q2. Operating efficiency went up 30 basis points, total efficiency up 15 basis points.
Basis points, remind us.
Right, 0.01%. So 0.3% and 0.15%. Looking forward, they expect the ongoing impact to be about a 90 basis point increase to operating efficiency and 50 basis points to total efficiency. But importantly, they said the net impact of these reclassifications on the actual bottom line profit is negligible. It's more about how costs are categorized now.
Okay, so a reporting shift more than a fundamental change there. What about NUM? That's always key for a bank.
Yeah, NUM came in strong at 7.62%. That's up a significant 69 basis points from Q1.
Wow. How much of that was Discover?
Discover's partial quarter impact added about 40 basis points to that increase. Now, that includes some offsetting things like a 6 basis point drag from those fair value marks amortization we discussed.
Right.
But also a 6 basis point tailwind, because Discover's late fees are now classified as interest income under Capital One's reporting. The rest, almost 30 basis points, came from improvements in legacy, Capital One, lower deposit rates, a better funding mix, plus one extra day in the quarter.
And looking ahead,
they expect the full quarter impact of Discover to boost NIM by another 40 basis points, all else equal. So a significant lift there.
Okay, that covers the immediate mechanics. Let's zoom out now. Beyond the accounting, what's the why? What's the big picture? What's management saying about the long-term strategy for this combined powerhouse?
Yeah, this is really the core story. The vision is incredibly ambitious. First off, discover integration and synergies. They say integration is going well.
Good start.
Yes, but they did flag that integration costs will likely be somewhat higher than the $2.8 billion they initially guided. That covers deal costs, tech migration, risk management upgrades, all sorts of things.
Higher costs. But what about the promised savings and revenue gains, the synergies?
That's the key point. Despite those higher upfront costs, they're sticking firmly to delivering $2.5 billion in total net synergies. That includes both cost savings and new revenue opportunities. So the ultimate prize, they believe, remains the same.
So the long-term target holds. How are they going to get there? What drives that $2.5 billion?
Well, on the cost side, it's the usual stuff: optimizing systems, reducing redundant operations. But the really exciting part, the big potential, is on the revenue side, what they call the network opportunity.
Ah, yes. Owning their own payment network now, that's huge.
It's unique. They're now one of only 2 major banks with their own network rails. Initially, the revenue comes from moving Capital One's own debit volume and some credit volume onto the Discover network instead of paying Visa or MasterCard.
Makes sense. Saves them money.
Exactly. Yeah. The real significant long-term potential, that hinges on investing heavily to build out Discover's international acceptance and make it a truly global network brand. If they can do that, they can potentially move much more of their own huge transaction volume and maybe even attract other banks or bigger spenders onto the Discover network eventually. They're clear, though. This is a multi-year journey, a patient, long-term investment.
A very long game. Interesting. And this ties into their broader tech transformation, right? They've been on that path for a while.
For 13 years, they constantly emphasize this bottom-up tech stack rebuild. Their goal, they say, is to be a modern technology company that does banking, not just a bank using some tech.
So tech first, banking second, almost.
That's the philosophy. This massive, sustained investment drives efficiency. It lets them innovate faster, improves risk management, enhances the customer experience. They believe this deep tech capability is the key differentiator in the future of finance. It allows them to move at a speed traditional banks just can't match.
And how does this tech focus support their organic growth, like with the national bank they've been building?
It's foundational. They're building this national digital-first bank organically, using that modern tech stack, a very light physical branch footprint, mostly those cafe-style showrooms, and their strong national brand. It requires ongoing marketing spend, of course, but the Discover network is seen as another major propeller for this strategy. Their simple no fees, no minimums approach has clearly resonated.
Definitely seems to be working. Now, that credit card market, especially the high end, You mentioned it's a battleground.
Fierce. That's another area of relentless investment for them, going back to 2010. They're focused on winning those heavy spenders. That means constant marketing pushes, premium perks, unique experiences. Think airport lounges, exclusive access deals like the Taylor Swift partnership.
Right, the Taylor Swift thing. It feels like a luxury arms race in cards sometimes.
It really does. But Capital One believes they can differentiate. They pointed to VentureX with its simple 2x miles on everything and flexible any airline redemptions as an example of offering unique value rather than just copying competitors. They think that, combined with unique access, gives them an edge, and VentureX is apparently showing strong results despite the competition.
And AI, the buzzword of the decade. How are they thinking about integrating AI now with Discover in the fold?
They see themselves as uniquely set up for it. Because of that modern tech stack and years of data investment, they believe they can embed AI deep into core operations, risk, customer interactions, not just surface-level stuff. They acknowledge some AI tools are available to everyone, but truly reinventing the business model with AI at the core. They think that requires the kind of tech foundation they've built. But again, it means sustained investment in the tech and the talent.
So you have all these moving parts, integration, network build out, tech investment, AI, yet management is saying the ultimate earnings power of the combined company, once integrated, hasn't changed from their initial projections.
That's what they emphasized, yes. Despite maybe some costs shifting or timelines adjusting, that core estimate of the combined company's net earnings power post-integration, they're holding firm to those initial deal announcement estimates. It's a really important anchor point for investors trying to navigate all this complexity.
Okay, this is where it gets really interesting for me. How do they see the broader market, the competition, the consumer? What are the currents they're navigating?
Well, on competition in credit cards, as we touched on, it's intense, especially at the premium end. They specifically mentioned the arms race in lounges and noted increased marketing by rivals like Chase and Amex. But their strategy isn't just imitation. It's about unique value props like VentureX's earn rate and flexibility, plus those exclusive experiences.
And the big operational shift moving debit cards to the Discover network, how's that going?
It's underway. They started pilots in June. The plan is to have the majority of customers moved over by Q4 2025 and all debit purchase volume running on Discover rails by early 2026.
What's the advantage there beyond just saving fees?
It allows them to have direct relationships with merchants. They can leverage their huge customer base and data to offer value to merchants, things like better fraud detection or targeted deals. It's a key step in building the network's value proposition.
Makes sense. What about their capital position after spending billions on Discover? Are they financially strong enough?
That's very solid. Their main capital ratio, Common Equity Tier 1, ended Q2 at 14%. That's actually up 40 basis points from Q1. They stated they have excess capital right now compared to what they think they need long term.
So comfortable then.
Seems so. They're still finalizing the models for the combined company's capital needs, but they did signal they expect to ramp up share buybacks once that work is closer to completion. That suggests confidence.
Okay, and finally, the big question. The U.S. consumer. How are they holding up in Capital One's view? Any warning signs?
Their overall take is pretty positive. They describe the consumer as being in really quite good shape, actually a source of strength for the economy. They pointed to low unemployment, solid job growth, real wages rising steadily, and debt burdens still near pre-pandemic levels and stable.
Any specific signs in their own portfolio?
Yes, encouraging signs there too.
Yeah.
They mentioned improving delinquency rates, fewer people falling behind on payments, and rising payment rates within their card portfolio.
But surely there are some watch points, things they're keeping an eye on.
Oh, absolutely. They acknowledge some consumers are feeling the pinch from inflation and higher rates. They also noted that the sort of delayed impact of pandemic-era stimulus on charge-offs is now fading, meaning credit losses are normalizing. And they're watching student loan repayments resuming closely, though they haven't seen any significant negative spillover into their credit performance yet.
What about the Discover customer base specifically? Any differences there?
Discover's card performance is also improving, they said. Though loan and purchase volume growth was a bit muted, partly because Discover had pulled back on originations before the deal. Historically, Discover's portfolio was known for being more revolver-oriented, more customers carrying balances month to month compared to Capital One's more spend-driven model where more people pay in full. But importantly, they stressed that Discover's customer engagement and loyalty metrics remain very strong.
Okay, so we've covered a lot of ground. Bringing it all together, What does this really mean for you, the informed investor trying to make sense of Capital One's path forward?
I think the main takeaway is this. This earnings call really hammered home that Capital One is playing the long game. This isn't about quick wins. The Discover financials right now are noisy, dominated by necessary, expected accounting adjustments from the integration.
It's part of the process.
Exactly. And management's clear willingness to invest heavily in the Discover network, in their core tech, in AI, in card growth, signals a deep commitment to creating significant future value, even if it means near-term spending looks high. That consistent message about the ultimate earnings power post-integration, that's a critical anchor for investors amidst all this complexity.
So they're positioning themselves less like a traditional bank.
And more like a tech-first financial institution? That's the bet. They believe leveraging data, AI, and now their own network will create durable competitive advantages in a financial world that's changing incredibly fast.
All right, let's pivot to our This Is Not Financial Advice segment. Remember, everyone, this is strictly for entertainment, maybe a little thought provocation. What have you got for us?
Okay, here's an outrageous but maybe plausible idea for you to mull over. How about a long-term bullish bet on Capital One? Maybe paired with a bearish stance on traditional payment networks like Visa or MasterCard.
Interesting. Okay, what's the thinking?
The rationale is this. Capital One isn't just tweaking things. They're making a massive, multi-year, multi-billion-dollar bet to make the Discover network a real global competitor. Job one is moving their own enormous transaction volume onto it.
Yeah.
Now, Discover looks small compared to the big two today. But if, and it's a big seep, if Capital One succeeds in building out that international acceptance, building a strong global brand for the network, they could start slowly chipping away at that Visa MasterCard duopoly and their very lucrative interchange fees. The potential value of owning the entire stack customer, card issuance, and the payment network might be seriously underestimated by the market right now. It's a high-conviction, very long-term play on financial services unbundling and the rise of these integrated fintech platforms.
Bold idea indeed. So there you have it, our deep dive into Capital One's Q2 2025 earnings. We've explored the huge Discover integration, their long-term tech and network investment strategy, and that confident outlook on earnings power despite the upfront costs.
And it leaves you with a key question to ponder. In an industry where tech and scale are increasingly everything, how much value should the market really place on a company genuinely trying to build a modern technology company that does banking essentially from the ground up, now with its own network?
Definitely food for thought. We always encourage you to check out the company's own investor relations materials and draw your own conclusions. And just a reminder, everything discussed here today is for informational purposes only. It is absolutely not financial advice.
Thanks for joining us on this deep dive.
We'll catch you next time.